Good morning, everyone. Welcome back to another Market Mates episode. It's great to be back with you all on this fine Tuesday morning. I think it's Tuesday morning. I'm still recovering from my big socializing weekend. I went to the footy, had a Bucks party. I'm still recovering. I still woke up this morning so tired. I was like, oh my gosh, just playing catch up. But we're joined obviously by Craig today, guys, as normal. But we've got a local friend of ours, Matt from Crypto Tax Made Easy. It's great to have both you lads on the show. How are you both doing? Matty, how you doing, mate? How's things with you?
Yeah, doing well. Just hit a pretty hard workout on the assault bike, and yeah, hopefully my brain turns back on by halfway through the stream.
Yeah, I love that, mate. I love that. Hey, morning exercise. That's something I still haven't quite got there in my life. It's just, I don't know why. Craig, I don't know. You used to gym a lot, Craig, too. Like, are you a morning guy? Or are you more of a throughout the day afternoon guy?
No, I'm definitely not a morning gym guy, man. I'm an afternoon. That's what's good about working from home is I actually get down there at about lunchtime when it's quiet. And it kind of, I find it quite good after the stream and stuff like that, just to kind of like, I get the podcast up, do the stream, and then go there to kind of get my brain sort of unfried again. Because sometimes doing a live, I find I can get a bit like wound up. So it kind of just brings me down and then I can work again. So I don't know if anyone's noticed, man. I got the microphone, guys. Is that coming through beautifully now to everyone? Does it sound better?
It is, but now you've got a delay. Now you have a camera delay. I don't know what's happening. I don't know. But hey, your audio's good, so that's fine. Craig, we're having technical difficulties, but it is what it is. Hey, mate, at least the audio is good because arguably I would say audio is more important than visuals when you're running a live stream.
Same here. Hugo, what's up, dude?
But GM to everyone, good to be back. Today's conversation will be very much around crypto tax. Will be applicable to obviously our friends overseas as well as more closely here in Australia as well with more recent specific changes here in Australia. But Matt, can you give us a little bit of an intro about who you are and what you're doing, how long you've been doing it?
Yeah, so I am the founder of a company called Crypto Tax Made Easy, and it's pretty self-explanatory. Our goal is to take something that sucks, crypto tax, and make it easy for our clients. So the way that we do that is pretty much if anybody's ever tried doing their crypto tax, you probably started with a crypto tax software. Probably saw the marketing promises like, oh, you just put your wallets in and wham, bam, slam, you've got these optimized crypto tax reports in minutes. But then, you take a look at the tax page and you're just like, oh, geez, that is way off. And then all of a sudden you have to like figure out how to become an on-chain investigator and a bookkeeper and an accountant. And yeah, usually people go through that pain, that glass chewing, and then they realize, oh, I need help with that. So yeah, we pretty much just help people. We go in, we make sure that all the transactions are properly categorized in their tax software. We make sure all the balances reconcile, which is pretty much like doing proofs in math. Make sure that the work is correct. And we make sure that everybody's got tax reports they can either hand to their tax agent or just self-file through MyTax. We also, for our US and Australian clients, we have some tax agents, CPA in the US, tax lawyer in the US, and we've now got a 17-year experience chartered accountant in Australia that we're onboarding, who's a tax agent as well. So yeah, we've got some really good licensed partners as well if you need help with advisory and filing and all that good stuff.
And I mean, that's arguably probably really important when we go through a significant country change like we've seen here more recently with proposed tax law changes here in Australia. So definitely good to hear that. Craig, did you want to start with questions or would you like me to go first? I don't really mind, mate. Would you like to?
I'm easy. You can warm us up if you like. Yeah.
All right. Well, I'll start with real basic. So what are some of the most common mistakes that people get wrong? Perhaps let's go crypto specific with tax. Like what are some common mistakes that probably people should be made aware of?
Yeah, easily most common mistake is that people think you only pay tax on what you cash out to fiat. And that can create some huge issues because in both Australia and the US, crypto to crypto trades are taxable. And in the US in particular, it's a little bit more of a filing headache because we have to file every taxable disposal of every tax lot we've purchased, which can, like for me, I literally, because I have to file my US taxes as well as my Australian taxes. So I mail my US taxes in. It ends up costing me between 50 to 75 bucks to send it from Australia to the US because of how thick my form is where I have to report my crypto disposals. That's a bit shit. But in Australia, we don't have to submit line by line all the trades that we made, but it is expected that we are accounting for each crypto to crypto trade. And so if you get audited by the ATO and you don't have those records, then that can be an issue. And if you only are reporting what you cashed out, oftentimes that underestimates, because usually we keep our chips on the table here in crypto. So usually you cash out a lot less than you actually made. So I'd say that's easily the biggest misconception that I see.
Yeah. No, I think that's definitely one that a lot of people, I mean, I still have people ask me and comment on some of the posts that you post about oh wait, don't I just pay it when I put it in the bank? It's like, no, legend. Like if you literally swap from ETH to USD, that's a taxable event. If you swap from Solana to BTC, that's a taxable event. If you claim an airdrop, that's a taxable event. Like all these sorts of things. And it's a big let's talk about airdrops specifically, because it differs from country to country. And I'm actually about to get a probably a little juicy airdrop, actually, a couple tens of thousands of dollars of an airdrop. So for me in Australia, how does an airdrop work specifically if I'm looking at it from a tax perspective?
Yeah, so luckily in Australia, initial allocation airdrops, so like what we would call a TGE, those are not taxed as income. So you receive it at $0. You have a $0 cost basis. And if you just insta sell it, as people in the US might, because they have a tax burden, then you just pay gains on the value that you took out. So, if you receive the airdrop, this is the good thing. Most of them are worth the most the moment you receive it. If, let's say you get like a 20 grand airdrop, and by the time that you can sell it with slippage, it's like 10 grand that you're getting out. Well, in a lot of countries, you get hit with a 20,000 income tax bill, and then you might have a $10,000 capital loss. But like in Australia, we can't use capital losses to offset our income, and in the US, you can only use 3,000 in capital losses per year to offset income. So people can really get wrecked by airdrops. But luckily in Australia, the ones you're most likely to get wrecked by, those TGE airdrops, not taxed as income. So you just pay tax when you sell. So realistically, like all projects should just airdrop only to Australians and give us the opportunity to transfer our governance rights if we want to. But we're less likely to, because we don't have to, instantly nuke like 30 to 40% of it to think about taxes.
Yeah.
So any project founders listening.
Hey, we'll be first on your leaderboard for your point system. So no, that's interesting. So there you go. I mean, my understanding was still even different to that. So that's good to clear that up before I get my little SLX DeFi on Solana this in 2 days' time, I think it is. So I'm excited for that one. Craig, I'll handball over to you, legend.
Yeah, I've noticed. I mean, one thing a question I had was, I've noticed since I got into crypto, probably I think it was in 21, and I think they were onto it pretty quick. We call them the ATO here for the Americans in the room, Australian Taxation Office. And I got a letter from them within, I think, 6 months and just to let me know that they were aware that I was trading crypto and to make sure to include that in my next tax return. So a friendly-ish letter, right? And I'm sure lots of us got that letter. Are you, just for the Australians in the room, are you finding, I think a lot of people think that perhaps the ATO aren't watching what they do, right? But I certainly found when I got that letter, I'm like, well, okay, they are watching, and that's going back to 21, 22. So are you finding now that the ATO are starting to catch up with the habits we have? Because I think the hard thing in the past with the ATO was what we actually do in the space. We get up to some weird stuff here. We get airdrops. We've got NFTs we flip. Are they collectibles? What are they? Are you finding the ATO now and the taxation office starting to catch up with the way we operate here in crypto and are now starting to put laws in place to capture that? And are you finding people that have perhaps skirted or avoided paying tax on that in the past? It might catch up with them, I guess, in the future if they don't start to report these things more accurately.
Yeah, so I don't want to be a fear monger, but like the ATO does and has had they call it the advanced data matching program in place for a little while now. And essentially, like any regulated like Aussie exchange or broker that you KYC with, like if the ATO asks them for information about a taxpayer, they kind of got to give it. So that might include things like your trades on the exchange, but it might include any withdrawal addresses or addresses that you interacted with. So they can kind of create a map of, okay, like what are your on-chain addresses? Like you might think that it's completely anonymous, but the moment that it touches an exchange, or the moment it touches a wallet or is funded by a wallet that touches an exchange, like the ATO potentially has visibility into that. And you asked if they were kind of like catching on to what we're doing and putting laws in place. I haven't really seen any laws being put in place yet, and like specifically around crypto, but they did back in, I think it was 2023, maybe it was FY24. They released this like pretty much blog post on how they thought DeFi should be taxed, and it was very not good for us. Let's put it that way. It was pretty much like, if funds move, it's a CGT event. Like they were just like, we are looking to get you guys every time you move funds around. Harry Dell, a tax lawyer, prominent tax lawyer here in Australia, he was pretty much like, that's a blog post. It's as good as toilet paper. Like, that's not a law. Give us some laws. And yeah, so like we've seen, for example, that Veiled, like crypto-backed loans company, they also, I think, have some crypto cards. They got a private ruling from the ATO essentially saying like, hey, if somebody takes out a loan, using, let's say, Bitcoin as collateral on your platform, then we're not going to consider that taxable. Whereas the ATO essentially said, if you put up CBBTC as collateral in Aave, well, now that was a taxable event. Like, if you had that CBBTC from, let's say, 50,000, you collateralize it, it's now worth 80,000. Well, that's a 30,000 capital gain. And then, you take out the loan, you then repay the loan, and then you pull it back out. And then when you pull it back out, whatever the value is when you pull it back out, if it's more or less than when you put it in, another CGT event. And so when it comes to DeFi, they were essentially saying like, CGT event here, CGT, it's like Oprah, you get a CGT event, you get a CGT event. And then, but Veiled, they went and they got a private ruling that essentially said, no, like, because it's, it's not a custodial transfer of the Bitcoin. It's not going into, a pool of other people's Bitcoin. You still essentially, it's kind of non-custodial. They were kind of like, okay, facts of the case. It kind of fits the opinion that we put out in that blog post. So yeah, if people are going to use Veiled, good to go. And I think with obviously the budget changes, we may see more kind of crypto-backed loans companies doing these private rulings, because it would be good for business for them to do so.
Yeah, definitely. I mean, like, because like Block Earner and stuff, they don't have that. So that's very interesting. So talk to me about that. So if it's non-taxable, then how does it work? Can I then take the losses against, well, would it be a loss against my income, or like how, so the government just doesn't get money from that then? And that's a way that, because the argument was, well, then I'm paying interest on money that I've already accumulated over time, right? Or paying CGT on top of that as well. So using that one that you just described, like, that's a good thing for us if we're creating wealth in crypto, right?
Yeah, for taking a loan that you don't have to consider it a CGT event upon depositing collateral, 100%. So, the example again would be like, if you're in DeFi, like I said, you bought some CBBTC at 50K, you then put it as collateral into Aave when BTC is worth 80K.
Yeah.
30,000 CGT.
Yeah.
Then if you put it in at 80K and you pull it out at, let's say, 100K, then there's another 20,000 capital gain there.
Yeah.
Whereas if you do that same situation in something like Veiled, where they have a private ruling that posting the collateral is not a CGT event, then it's just, you've got a 50,000 CBBTC cost basis. You put it into, take out the loan, the USDC or AUDD, if they start getting more integrations. If you actually pull that out, borrowing crypto, it just sets the cost basis. So, let's say just for ease, you take a loan of 10,000 AUDD. Well, that's 10,000 AUD cost basis. Even if you go and you pay that back, like there's no capital gain. Now you still have this 50,000 cost basis CBBTC sitting in, you know, your loan collateral. Well, if you pull it back out, now it's just the same as it was before. It's one CBBTC at 50,000 cost basis. If you then sell it or do something else, you know, the cost basis is transfers, but there was no CGT event in and out. It also is good because it means that you've more likely kept your holding period so that you might qualify for the long-term capital gains. But with the budget changes, how good is that anyway?
Well, yeah, let's talk about that specifically. And then I want to come back to Jabs' comment in the chat there as well. But yeah, government's plan in Australia to help. I mean, this is my this is my engagement bait tweet, so ignore the first post. But anyways, 50% CGT discount gone, negative gearing killed for new investors, 30% minimum tax on capital gains, trust income hit with a 30% floor. So talk us through these changes, what that means for maybe people who trade as a sole trader in their own personal name. Okay, so it would be income. And then also talk to us a little bit about maybe people like myself who trade under a company, and therefore the trust sort of is the one that comes to my sort of conversation.
Yeah, so I guess just following on the like capital gains discount, prior in Australia for any of our fellow burgers, there is a 50% capital gains tax discount when you hold for more than 12 months in Australia. So if you were doing very well, which in Australia is pretty much like over 190,000 a year, then your tax rate's effectively 47%. That's your income tax. So if you are short-term trading, anything less than 12 months, you get taxed on your gains at that income tax rate. So now with the budget changes, they've put in this minimum capital gains tax of 30%, which sucks for anybody who's not killing it, which we'll talk about in a second. But you know, you essentially get taxed at your income tax rate with an inflation adjustment. So like if inflation is, if they say that it's 4% over the course of the year, then you might get a 4% inflation adjustment on your income tax rate. Now, where it really hurts is if you are not earning at that top level. You know, if you're earning, let's say, like the average Australian at, you know, 75,000 per year, you know, your average tax rate might be up to 16% income tax rate. But now if you know, held on to Bitcoin for 5 years and, you know, you sell it for a huge profit, you know, you finally are trying to get ahead and get yourself a nice home deposit and you sold your Bitcoin for 100 grand. Well, now all of a sudden you might have paid 16,000 in the old model in tax, but now you would pay 30,000, almost twice that. So, you know, it makes sense what they're doing for property, which is naturally a long hold, you know, inflation adjustment. Like it's actually for anybody who's holding their house till like the maturity of their loans, like 30 years, it's probably going to be better than the 50% CGT discount. But for any assets where they're more volatile and therefore you're probably trading them on shorter time horizons, like the adjustment actually kind of sucks. So yeah, were there any other parts of that I missed?
No, I think you covered that pretty well. So talk to us specifically then about the trust side of it too. So for someone like me who trades via a company, my tax rate is 25%. And then obviously you would distribute that via a trust. And then ideally the trust would then go out to myself or obviously my wife or obviously independents if you have children in time as well and they meet the requirements. Talk to us about that change now because it's also being changed or proposed to be changed from 2028.
Yeah, so a really popular setup for tax, especially for people who are married or might have like older kids, was to essentially have a company where your tax rate is 25 to 30%. And then to distribute dividends to a trust, and you kind of get a credit for the tax that you already paid in the company, and then you distribute from the trust to the trustees. Now, the benefit of this is that, as I mentioned before, the tax rate for the highest bracket in Australia is very low compared to the US. It's 190,000 in Australia. Like, to get to, like, you don't even get to that 45% tax rate in the US at all. But to get to the highest tax rate, you're like earning over 600,000 a year. Like, it's up there. So what people who are higher income earners in Australia might do is then they might use the trust where you might send, let's say, 400,000 of dividends into the trust, and then you might have 4 trustees. So now, instead of paying tax essentially at the 45% tax rate on like 210,000 of that, you actually just distribute 100,000 to each trustee, and now each person is paying the tax rate at 100,000. And which is substantially less. Probably average tax rate is in that 25 to 30% range. And so now the tax the company already paid and the credit that you get with that, it's kind of no further tax owed for the trustees. So the company kind of pays the tax at a lower tax rate, you distribute it to the trust, and then you're essentially effectively able to reduce the tax rate. Now, as far as I understand it, and I haven't honestly done as much of a deep dive on the trust stuff from the budget as I should. But as far as I understand it, there's kind of a minimum tax on the trust of 30% as well. Yeah. So looks like that setup is designed to avoid people who are sending to the trust to kind of like parcel off the income or the dividends into like tax rate lower than 30%. They're essentially saying no, like everything's getting stepped up to a minimum 30%. So anybody who is using the trust for, let's say, smaller distributions per year is kind of getting screwed by that.
Yeah, very much so. Yeah, no, that'll be a conversation I'll have to have with yourself and obviously my other accountant in the coming years. So we'll wait and see. Craig, I'll hand it back over to you, Legend.
Yeah, I thought we'd go just onto Jabs' question real quickly because it kind of coincides with everything we're speaking. And Jab said, licensing of sexes will arguably give ATO greater visibility. Now, that's happening now, isn't it? That licensing is being enforced now, I believe.
I'll add to that because it's like so many people think that they can get away with it. Like there's so many people that I know literally getting away with it. But unless you're strategic and in terms of you have like anonymous processes from way back in the day, you will be like, as Matt said earlier, like the companies, exchanges, etc., they have to report to the ATO now. It's like law for them to report all of the details, all the customers, all that sort of stuff, which is why you would, and maybe Jabs as well, would get a letter in the mail. Even like, say, my sister who bought a bit of Bitcoin a few years ago would be like, oh, hey, have you declared your CGT for the Bitcoin that you own? Because we know that you own some sort of thing, right? So the point I wanted to talk to Matt about this is I think a lot of people might misunderstand that. Look, particularly because you have to onboard and offboard so that it is, as you said before, you can map it. And I've met Gabby from SwiftX. I've met other on-chain analysis. And dude, these people are insane. It's like I can't even describe it. They are insane with tracking it because obviously I got scammed just over a year ago. And when I was dealing with that, like it's incredibly, like even if they throw it through like DeFi mixers and other like non-KYC platforms, they can track it so far in advance. Like it's astronomically crazy. And that's because the tech's getting better. People are getting better. The skills are becoming more understood. So the point I wanted to talk with Matt about is like, basically, if you have ever signed up to an exchange and you have deposited cash, whether it's via a card, whether it's by a bank account, you probably will be on the radar of at least the ATO here in Australia, but likely probably other countries as well with their same systems.
Yeah, dude. I've got plenty of people who they love to tell me they're like, I've been evading taxes and nothing's happened. I'm like,
that's great.
Good on you. Like I'm not a Fed. I don't care. Like good on you, dude.
That's like saying I've been robbing houses for a decade and no one's caught me though. It's like, well, maybe one day someone will though. That's the problem, I suppose. Yeah.
Yeah. The big issue that I see potentially for people is it's like 1,001 days in the life of a turkey. You've seen that chart?
Yeah. I haven't. No.
Yeah. So in the US, there's Thanksgiving, which is a holiday where, you eat turkey. And yeah, it's just this chart where it's like the well-being of the turkey over time. And it's like the well-being just goes up because it's just getting fat and happy. The farmer's feeding it, taking care of it. And then boom, well-being goes to zero when it gets its head cut off. So the thing that I have found is like there's a lot of soft enforcement happening, both in the US and Australia. So essentially, like it's not straight to an audit. Like, we're pulling your pants off and having a look. It's like, hey,
Gotcha.
we see that you may have misreported in the digital asset space, and we're requesting that you provide documentation of your transaction history. And then at that point, you have a pretty short period to be able to get your documentation together and present your case. Now, sometimes like your case is, hey, like here's my documentation. I had we have some people who they had not been filing. They've been in crypto since like 2017. They got a soft enforcement letter. And they're like, hey, can you do like 100,000 transaction review in the next 30 days? Wow. And it's just like, oh man, that's brutal. Like no taxpayer would be able to do that themselves from scratch. And it's like, we can, dedicate 2 accountants to it and get it done really quick. Just putting them around the clock. But like, man, it's really tough, one, to get that documentation together on time. The other thing that's bad is, like if you weren't actually paying your tax and you did have big gains in the past, even if you lost it in a subsequent year, like let's say you killed it in 2021, lost it all in 2022, and then all of a sudden you had a big run up in like 2024 again on meme coins and like the post-Trump inauguration pump, and then you just lost it all like in Melania again. Well, the tax office doesn't care unless you're in Canada where you can carry losses back 2 years. The tax office just cares about things sequentially. So if you had a gain in 21 that you didn't pay tax on, well, now that you owe that unpaid tax plus an incredible amount of interest and penalties. Same with that like 2024 gain. You might have lost some money in 22. You might have some carry forward losses that might soften the loss, but then you again like have penalties, maybe not as much interest because it's shorter in the past, but not paying, there is a substantial risk to it if you do end up getting caught. So people in crypto are risk takers. It doesn't surprise me that some people are rolling the dice on that. But yeah, for the people who are like, yeah, I'd rather just enjoy my money, cash out, like I'll pay my fair share and not have to look over my shoulder for the rest of my life, like then it makes sense to get square.
And I find the thing in Australia that I'm noticing, and I'm sure everyone notices this, is they're tightening up on everything. That's including cash. I mean, you go to the bank and you try and put in more than about $3,000, which I've done, and even if it's your bank, you've got to put into your bank account. You can't put into a stranger's bank account. You can't actually pay for items. I actually went to pay for a chair 2 weeks ago. Someone was selling a chair and their bank account was Commonwealth Bank, and I couldn't pay $1,300 into their account with cash. The Commonwealth Bank won't accept cash payments. It has to go into your bank, whichever bank yours is, and then you've got to transfer it. So I guess the reason I'm bringing that up is that the ATO now and the banks are just, there's very few ways to skirt the system now, isn't there? And I think people are going to get called out over time that have been trying to do that. And I think now with Jab's comment about the licensing of the sexes, which is coming in here, well, it's already here, am I right, Grady? They already have licensing, isn't it? But is it stricter licensing? Is that?
I don't know, I would assume, yeah.
Because,
I mean,
yeah,
I know that they are licensed. I don't know. Yeah. I'm not a centralized exchange and broker licensing expert, so yeah. Jabs probably knows better. We should probably ask him.
Yeah, Jabs probably does know better. I mean, I would say yes. Like, as I said before, I'm pretty sure it's that, like, if the ATO, as Matt said, comes knocking, they have to provide. It's like illegal, like, because their country is based in, their company is based in Australia, so they fall under the legal tax system of Australia, so they have to be compliant to that. So yes, I would say it's been licensing for quite a while. It's the people like, I'm not going to disclose any names. It's the people who move overseas. I think a lot of people are like, Australia, shit, I don't want to pay tax here anymore. I'm going to move to Dubai. I'm going to move to Thailand, whatever it is, right? It's like, well, hold on a little bit, legend. Like, I know obviously Matt can speak on this specifically, but you will probably owe tax at some stage, even if you've made a lot of money in crypto. So what are some things that people should be aware about as maybe an Australian as well, but before maybe looking to move elsewhere or becoming a tax resident of a different country? Because I know a few commenters on a few of my viral posts over the last couple of weeks have been, Greeny, why you still live in Australia? Bro, you move to this country, go over here. Like, New Zealand has this deal. Like, I've had so many people. So what are the things that if someone was perhaps like absolutely smashing goals in crypto or trading or whatever it is, and they're like, you know what, I'm sick of paying 47% tax because they don't run a company, or they're sick of obviously not being able to get all their money and all of that sort of stuff. What are some things that we need to be aware of if we were to perhaps leave Australia, particularly at the crypto and the tax sort of side of things?
Oh man, can't imagine wanting to leave Australia, like to genuinely want to, but
I agree with that. I agree. It's a great country.
Yeah. So one of my best friends, he did move overseas for tax reasons, and I understand his thought process. Like, he was like, you know what, I can move overseas in my best earning years, and I can essentially get my tax rate down substantially, both on me and my business. And then I can choose to live wherever I want. Once I've, got through my best earning years, maybe I'll want to go back to Australia. Maybe I'll find somewhere else. Long story short, he wants to come back to Australia, but I was there with him during the process of leaving. And so within Australia, as well as the US, there's an exit tax that you have to pay. So essentially it's like, they treat it as though when you leave that you've sold everything, even if you haven't. So, if you leave, you've got this crypto portfolio. So you essentially have to treat it as, like, let's say that you leave on the 30th of June. You're like, I'm not starting FY27 in Australia. Fuck that. And you leave. So then essentially it's as if every asset that you own at that point in time gets sold on the 30th of June for its fair market value. And so the best thing to do is to time it. My buddy, he nailed it. He left in 2022 in like peak bear market. And he was just like, overall, he was in the red. So the only thing he really had to pay tax on was he sold his house. And but it was, oh wait, shit, no, that was his primary place of residence. He owed like zero exit tax. It was like crazy. I was like, how did you pull that off? You're so like, you're proper wealthy, and you pretty much owed no tax on the on the way out. And so like leaving when your portfolio is down is ideal. Now here's the thing: he had worked with a tax lawyer, and the main thing was you have to like properly sever ties. If you have any ongoing interest in Australia, the ATO can come back and be like, you didn't sever ties. You are still a tax resident in FY27. And then they can come after all your earnings that you had overseas. So you might have found like, zero tax rate somewhere else. You might have moved to Dubai, maybe. But ATO is like, nah, that's not how that works. And
what are some of those examples? Like a company maybe paying parents via bank accounts? I don't know. Give us some examples of things that you should be aware of.
Yeah, so it would be like if you still own a house, if you still have an operating business, like those types of things where it's like, well, dude, you didn't really sever ties. So yeah, you kind of want to make sure that you just fire sale all of your assets that can't be transported with you, like crypto. You got to close your brokerages in Australia, like that type of thing.
You're basically starting from scratch in that new country that you moved to, right?
Yeah, pretty much. But then, you might like be bringing your assets over, and it's like, okay, well, it like for him, it was like, okay, I essentially didn't have to pay tax to Australia, brought my assets over, continued to hold them. Then a bull run happens, and he's kind of at a zero tax rate. For my buddy, that was a really good move. But the thing is that he's told me that he just like he's kind of ached for coming back to Australia from like the first 2 years. He was just like la 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 la, and then he's been telling me lately that it's like I've been I've been aching to go to Australia.
That's
yeah,
interesting.
you miss home after a while, eh? I certainly would feel that way, and that's why I probably couldn't leave Australia. Just it's home now, and things like that. So I know for me, after, because for a couple of years you're kind of a tourist, aren't you? You're like, this is great, I'm in a new country, and then after a while you're like, shucks, I miss my family, and I miss what I call home, and you know, your traditional meals and the footy maybe, or the league, and all of the things that make you feel like you're at home. So I guess, I mean, my question, just for the simple people in the room, it sounds like what you're saying, Matt, is that just simply leaving the country, say to Dubai, to skirt taxes, that's not actually going to solve your problem of having to pay tax on crypto, is it? You're going to have to effectively get value. So I left today, they would look at my wallet and say, right, what's the value of your wallet at that time? It's the same as me selling the crypto, really, and not leaving, isn't it?
If you're in
So
a profit.
it sounds
If
like
you're in a
it
profit.
doesn't.
Yeah.
If you're
Yeah.
in profit, it sounds like leaving doesn't help. Not the tax situation. In time, it will later, but your current situation, it won't fix. If that's what I'm hearing.
Yeah, it won't fix current situation. It stops the bleeding, so to speak, on an ongoing basis.
Because I'm sure there's loads of people now, because I had people in my comments saying stuff like that as well. They were like, well, just leave. And I'm like, no, I don't think
It's far more
the
complex.
Australian, I think the government's a little bit onto that one now. You know, they've been around a little while. They've been around the block before. They're not going to just let us go, I'm taking my Bitcoin. See you guys. And like, that's all right. Come back when it's on a downtrend again. I'm like, yeah, no problem. I'll be back at 40K and we'll go again. Yeah, I kind of figured that would be the case as well.
All right, so let's move to, we spoke about airdrops earlier. How does the ATO and even the US, how do they treat staking rewards, referral bonuses, trading competition, yield income, all these sorts of things, all the parts of, unless you're a degenerate, you're probably listening to the show going, what are even some of these terms? But for a lot of people who are involved in crypto, they're probably like, oh yeah, this is actually a really valid question.
Yeah, a lot of the kind of blanket answer is that both the ATO and the IRS would consider those to be income in most cases. But yeah, for like our US clients, when it comes to proof of stake blockchains and staking rewards, you can do these things. It's kind of like a private ruling in Australia, but instead of going to the ATO and pleading your case and hoping that they say yes, it's like rather than asking for permission, you get a licensed tax professional to look at the situation.
Yeah.
They put together this tax opinion letter for you that should be based off of relevant case law and the tax code. And then they may be able to essentially say like, okay, you know what? I don't think that your staking rewards on a proof of stake blockchain should be taxed as income. So then it's similar to what I was saying to Granny before. You get it at a zero cost basis. If you sell it, it becomes capital gain or loss. So we do have some, like both a tax lawyer and a CPA in the US who, depending on the facts, will usually be willing to write these tax opinion letters for people on staking rewards in particular. It's usually rare that it makes sense to do that unless you're like, running a validator operation or, running a node or, significant mining activity.
I wish I had an ETH node. Take me back. Anyways.
Yeah. So, so there are some cases where, there may be an argument to be had that that's not income, but generally, when you're earning those things, it tends to be considered income at the fair market value when you receive it. So airdrops is the biggest kind of risk because especially around that initial allocation, the volatility, and we see airdrop charts is like, poof, crime, poof, down.
Yeah.
So, you can really get screwed if you like receive the airdrop really high and then you don't get a chance to sell it until it has dumped, because the loss when you sell it doesn't necessarily offset the income from when you received it.
What about
luckily for things like?
Yeah, no. Yeah, finish your point. Yeah.
Yeah. Luckily, things like referral rewards from like an exchange or something like that, it's usually paid like USDT. So not really volatile, whatever. It's not a big deal. But for these volatile things like staking rewards can be, or yield farming rewards, those can be volatile, and you do have to kind of pre-plan and be like, okay, I'm going to sell 30% of my rewards to just set aside. And that way I know tax is covered, even if this token that I've received just dumps to the core of the earth.
So what about like, I think this airdrop that I'm about to get from Solstice, I think I'll get a portion, then the rest will be vested. So what happens if it's a daily drip and I'm getting, I mean, I've had that a few times where you get a token supply amount per day for like a 90-day period or a 2-year period, whatever it is. Is it the same case, or like, does that reset your cost basis? How does it work then specifically?
Yeah, I mean, in this case, it's one of those where you probably want to make sure that you've got a tax advisor who can look at the facts of it and determine, like, okay, how does this need to be taxed? In this case, where you where you are receiving an initial allocation and then it's vested over time, I would still argue personally that, well, that was the initial allocation. I'm just, pulling it into my wallet over time. And so, like, let's say, for example, if I was like in your crypto tax software, how would I do that? I'd essentially say, well, what's the total amount that Greenie is planning to get? So we're going to pull that. We're going to pull the initial amount that goes into the wallet, and then we're going to create kind of this holding wallet for the vested portion. And we're going to put that in, let's say today, into that holding wallet. And then each time you receive the little drip to your new wallet, we're essentially going to say that it's like a withdrawal or a self-transfer from this like holding wallet into your actual on-chain wallet. And then that way, we can kind of capture what's actually happening. We've had a few clients who for example, were an early contributor to like Bonk. And so they bought like what ended up being millions of dollars worth of Bonk for $1,000. And so, they contribute $1,000 early on. And so we essentially treat that, in the tax software, it's like $1,000 trade for all this Bonk, but then it's being vested over years from Streamflow. So then we're essentially just saying, well, your, $5,000 worth of Bonk that you got today has a 10-cent cost basis from the initial 1,000 you put in. It's essentially the same thing as income, but it saves you from having those vesting events essentially be considered income, which, as I mentioned before, sucks because if you have losses, you can't use that to drop your income. So,
yeah, okay, yeah. What are some records that crypto users should be keeping so that they don't get destroyed at tax time? If you obviously aren't someone like myself who uses, like I use some, Coinly is another one you can use. If you don't use these tax softwares to track, and I honestly, if you're anybody doing thousands of transactions, I highly recommend you should, particularly across multiple chains and multiple wallets and multiple central exchanges as well. What are some records that perhaps the common person should maybe be keeping aware of?
Yeah, like 100%, I think you should be using a tax software to keep your records because it just makes it so much easier. Even though, like, a lot of people complain, and I kind of put fuel on the fire, but they complain that, tax software doesn't live up to what it says. It doesn't live up to you just put it in and then you get your reports. It doesn't do a great job of doing the calculations, and it doesn't do a great job of automatically recognizing what a transaction is. It always requires some human review. So people are like, well, if I have to if I have to hire Matt to do this, or if I have to do this myself, like, what's the point of paying $200, $500 a year for the software? But if you've ever, like, I've been tracking crypto taxes since 2017 when it was like doing it in Excel. And back then, even when I was doing like maybe 50 like weird ICOs, let's say in 2018, that still sucked to like pull out information into the spreadsheet. So yeah, if you're doing thousands, like the amount of time that you'll save just from having the data pulled in for you, especially if you're like heavy on chain, will be huge. But if you're mostly trading on exchanges or, mostly doing like futures or perps trading, you kind of don't need the crypto tax software for that. You can do that in Excel because most of these platforms, you can pull your trading data as a CSV file, and then most accountants should be able to work with that in Excel. So the main thing is that you need to continuously pull those CSV files because, like, MEXC, for example, they will just like delete your data after 18
Yeah,
months.
dude, it's so
Really?
Yeah, so the amount.
yeah,
Yeah,
great.
yeah.
Is that a feature or a bug, do you reckon?
I'm-
6'7", Craig, 6'7".
yeah. So yeah, you want to make sure that you're pulling that data, because the other thing is like with Hyperliquid, luckily now I think it's like Hypedexer they partnered with, and you can get your historical data. But on Hyperliquid, traditionally, if you just went into the like if you're pulling the data from an API, it'll only give you your last 10,000 trades.
Yeah.
If you're pulling the data via CSV, same thing. So like if you go in onto the Hyperliquid app and you go to download your trade history, you may realize, especially like if you've been doing any market making type of stuff or really aggressive limit orders or TWAPing, you might realize that, oh, actually, some of my early history is missing. Luckily now, I think though with Hypedexer, you can get a little bit deeper into your history and you should be all right. But yeah, the main thing data wise, if you're primarily on exchanges and perp dexes, just pull that data.
I didn't even think about that. So I should be pulling data for Hyperliquid because I've been trading on there. Oopsies.
Yeah.
Oh shit. Okay. There you go, chat. There you go.
But well, I think we have it. The thing is, because we have it on some, it will pull on a rolling basis. So
yeah. So okay. Yeah. Cool. Because like
so some some captures the data.
Yeah.
It doesn't just like get deleted. Like they'll capture it and they'll keep it
and store it. Yeah, store it there. Yeah, no, I figured because I was like, wait, this is like my hot wallet that like I trade on most days of the week, so it should, in theory, still be active on the platform. Okay, so that makes sense. Cool. I keep asking questions. Sorry, I'm just so intrigued by this topic. I'm someone that needs to understand shit. If I'm taking part of this world, I need to understand it so I can make the right decisions and be aware of it. So as you said, so you're not like looking behind yourself every day you walk along the street. So I will handball back to Craig in a minute. What about non-KYC exchanges then? Because I know that's a big thing that a lot of people love to do is they're like, oh, I don't have to KYC to this exchange. Hell yeah, I get to trade in it. Or it's like geo-blocked, right? Like I know for Bybit, for example, that's where I like to trade, in my opinion, most of the day. However, a lot of people like in America, they can't actually use Bybit. So how do you like, is it still the same process? Like if you are no matter where, like, I mean, okay, I'll take it back a step. No matter where you are, you should probably be downloading your CSV files, downloading your history, storing it somewhere, and then probably giving it to a accountant, particularly if you have thousands of transactions. However, maybe a lot of people aren't aware of that sort of stuff. So perhaps, again, how do you treat non-KYC exchanges? Because one of the biggest, I know, like I'll talk from my experience working with you guys, is like one of the biggest sort of flags that appear is always, oh, Greeny, where's this money going from here to here? And it's like, no, well, this is just one centralized personal exchange to the next centralized personal exchange, but it appears as though it's just a random wallet. And you're like, well, hold on a minute, I've got to backtrack this and work out which one it is. So for non-KYC exchanges, how does that all, it's treated the same, correct?
Yeah, it's still treated the same. Some people will be like, oh, I'm not going to report it because I didn't KYC it. The problem is like another huge mistake you asked at the beginning of the stream is people think that, well, I'm just not going to tell my accountant about this wallet or this exchange that I used. But now there's this huge hole in your data. And so, we might not have a record of like when you transfer funds from that exchange back to your other exchanges or wallets that you've KYC'd, we don't have a record of where that came from. If you get audited, if you can't substantiate where that came from, the default assumption is that that was income. You earned that as income somewhere and you're, not reporting your income. We saw someone in the US get audited by the IRS, and this was due to like essentially, I don't know if you guys remember Poloniex, but they lost access. Yeah. So, Poloniex went under, they lost access to their records, but the US had already, I think, subpoenaed Poloniex and had client records. So, put this guy under the microscope, and he wasn't able to substantiate where, because he was sending funds to and from. Yeah. Just that transfer volume, even though he wasn't like a whale by any means, but he had 2 million of transfer volume over the course of years. And so they were like, okay, well, the like million that is being transferred into your accounts, we're going to consider that income if you can't prove where it came from. So we essentially had to like go through and prove, the inflows and outflows from Poloniex, labeled hot wallets. And it just like created a huge issue. Sometimes it can cause inflated gains. Like I had someone recently who was like, oh, like, sorry, I didn't think that it was important that you knew about these kind of like burner wallets. And I'm like, but you lost money. They're like, yeah, I lost money. I didn't think I needed to report it. I'm like, well, you're telling me that your gains are inflated from the reports that I provided you. I asked about those wallets. You're like, I don't know. And now it turns out that that's where you lost all your money. Like, of course your gains are inflated because you're not claiming your losses. Yeah. So, that's another thing where like, realistically, not a lot of traders are profitable. So like if you're going to a non-KYC exchange and you're just blowing through bankroll and you're like, well, I lost money, I'm not going to report it. Why not? Take advantage of that.
Yeah. I agree.
That's you should report, right, is the losses. I'm not saying you should report everything, but I'm just saying, like, you don't want to forget to report the losses. If you're going to report the upside, you've got to report the downside just to make it fair on yourself. I was going to ask Matt, what's I don't know if we covered this, but it might be a good sort of summary. What are some common misconceptions with people? We could go country by country. You see, it's tricky because it's country by country, but maybe for Australia specifically, you could probably cover the US, so maybe you can give a blanket statement. What are some common misconceptions with tax and how it works and things you see everyday people doing wrong?
I've kind of covered two of the biggest ones. I think the other one is just around like DeFi. Like most people just have no idea how DeFi is taxed. And some people will, for example, like provide liquidity with a token that they've held for a long time. And, they might reset their holding period. Like, they might be like 11 months into holding a token. And then all of a sudden they're providing liquidity and then they just miss out on their capital gains discount, the long-term capital gains rates. They put it into the LP CGT event and then they take it out CGT event. And some people aren't necessarily thinking about their like tax planning in their head. They're not thinking about like, especially the DeFi CGT events, especially in Australia, and what those kind of can add up to. And sometimes just because, the tax year ends on an arbitrary date, it's like it ends on the 30th of June. And you might like by August, you might be like, oh, I've lost money. But, on the 30th of June, you actually had accumulated some substantial gains and you may not have put money aside. So I think one of the biggest issues that I see is that people aren't planning ahead on their taxes. They're not getting a good understanding before the tax year ends about roughly what is my current tax burden, and is there anything that I can do, like in Australia, is there anything I can do now in May that's going to reduce the tax that I have to pay, by the time that the financial year rolls over? Or in the US, it's like you want to be like around November, maybe December if you're pushing it, but like that's the holiday season in the US where you're going to have a lot of trouble getting in touch with your accountant. Like do that planning, because then you can also take a look and see like, do I hold a bunch of worthless NFTs? Have I held a bunch of meme coins to dust? Is there anything that I can tax loss harvest right now and just make sure that I'm, not paying max tax? There's so many people, especially from 23 to 24 and 24 to 25. Like there was actually like end of the year in 23. I don't know if you guys remember, but like WIF and PopCat and a few other meme coins popped off. And then there was all these like derivatives and betas early in 24 that people just lost their shirts on. Yeah. And so they had this huge gain in 23. They pretty much lost their whole bankroll before the tax deadline in 24. And then, they were like, well, what money am I going to pay my tax with? That's a huge issue, is not setting aside enough money to cover your tax. And that just comes from not knowing how much tax you owe and making the wrong assumptions. 24, 25 was the same thing. Trump pump at the end of 24, like sure, Trump launch was a huge wealth creation event, but before the April US tax deadline and payment due, most people lost their shirts on the derivs, Melania, Libra, all that. They were just, chasing it, and they had these huge gains and then boom. It was just they lost their shirts and they didn't have money to pay their tax. And it's so sad to see because the IRS has like zero compassion.
Yeah. Oh, I mean,
especially for young guys.
So is the ATO. They don't give a shit. Like if you made money on their books in that year, you owe money. Like, and that was a big shock. Yeah. I think this is why I'm so aware of it today, and why obviously have you, and I obviously have Shane as well. But like because I got stung in 2021, I had made like a decent amount, like $50,000 from like a $5,000 portfolio. Then I got stung. I lost instantly to a scam. I lost like 40 grand like within a day, chasing NFT mints or something like this. Anyways, I then reported it all to the ATO with my previous accountant, and they're like, yeah, you still owe $5,000 for tax. I was like, oh my God, what? I was in debt. Like it was crazy. Like it was just, and so that stung me real bad because I was like, okay, well, one, I should be pre-planning, as you said, Maddie. Pre-planning, having a budget is a big one. So many people don't even budget day to day, let alone probably with their crypto trading or the company and all that sort of stuff. So that's a lesson in itself. But yeah, unfortunately in this industry, it seems to be a common occurrence that people need to have shitty experiences, or they need to lose money, or they need to get scammed before they start to wake up to the reality of better procedures moving forward. And that's just really unfortunate. But unfortunately, that's they can listen to a show like this and we're telling it from experience and qualifications, yet they will probably still go and make the same mistakes after the fact. That's funny you brought up tax loss harvesting, because that was going to be my next question. But how does someone particularly, it's common in Australia and obviously in the US. How does someone step into the world of tax loss harvesting without it appearing to be wash trading? I'll let you answer. Before I give anything specific.
Yeah, so that's all good. I'm not a fan of the wash trade tax loss harvesting. It's not like a lot of people talk about it like it's this silver bullet tax strategy. Mm-hmm. You might have seen that post that went viral where it was like, if you have one Bitcoin, and you sell it at 69,000 and blah, 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 you still have one Bitcoin and, you have a tax loss. And it's like, yeah, like in a simplistic manner, that makes sense. But now you also have like a lower cost basis Bitcoin, depending on how long you held it. You might have tax loss harvested it at long-term rates, and then now you've essentially reset the holding period. And if you sell it, 6 months later, now you've lowered the cost basis. You will sell at a gain in 6 months at a higher tax rate. So it's not this straightforward, like it's guaranteed to save you on tax. I find that method should only be employed very strategically. In Australia, wash sale rule extends to crypto. So if you sell and then within 30 days you buy back, you can't even, like the loss isn't even allowed. So, and that's the same like in the UK and Canada. US is the only country really where that like wash sale doesn't directly extend to crypto. However, I do have some CPA friends who essentially say like, if there's clear intention that you're doing the wash sale for tax purposes, then, you could still potentially have the loss disallowed. So that's one of the reasons that I don't love the wash sale as a strategy. Is it's just more risky. And it's not as guaranteed to save you on tax, like overall. The type of tax loss harvesting that I'm a huge fan of, as I kind of alluded to, is like you sell your dust, you sell your worthless NFTs. A lot of people are afraid to do this because they see, occasionally every now and then there's a chart that just gets crimed. And they're like, if I just held, I would have had 100x. But like, if you've got 100 tokens that you hold to dust and one of them 100x's, but, and if you just tax loss harvested them all, you usually end up saving about as much on tax or more as you would from, having just luckily holding onto some dust that crime pumps and is actually worth something. So yeah, selling off the assets specifically that you've lost conviction in can be one of the best, lowest risk ways to tax loss harvest. And that's generally what I'll do is I'll, take our clients like holdings reports at the end of the year, and it gives us an idea about the cost basis of their assets. And then they themselves can go through and be like, well, oh, wow, like I can't believe I spent 20 grand on that piece of shit NFT that's worth 0.01 ETH now. Like I'm going to go just dump that thing into whatever bid exists. So yeah, that's my preferred method. And, for me, that's ended up being like 4 to 5 figure tax write-off for me every year, because I definitely can't pick every winner.
I mean,
I have a fair share of losers in my portfolio.
I mean, so does everybody. Anybody that tells you that you only win every time is a red flag. Avoid those sort of people.
Yeah.
I mean, look, I won't lie. We did that on our Pudgy recently. Like I bought that for 21,000 US April last year, I think it was, maybe around that period. And I was like, oh, hold on a minute, like it is across tax years, but I was like, well, it's now only worth $10,000. Well, that's in theory 11,000 loss. Well, let's hope I've made some money elsewhere. I might as well take that. Look, people are going to misconstrue this, but look, I'm still bullish on the Pudgy ecosystem. But for this short period of time, look, let's just go buy an 8 for the same amount and see if we get another tax loss harvest in a year. No, I'm just kidding.
God willing, God willing, Greeny.
Yeah, God willing. I mean, you've done the same sort of thing as me too, Craig. So we're in the same party there. So yeah, look, it's just about being aware. I think that's the biggest thing. Is so many people. This whole conversation is about, hopefully, to everybody who's listening back on our podcast shows and obviously on YouTube and X and everything, is it's just creating awareness around this topic. Because as you said, when you literally started, you're like, this is no one wants to talk about this topic. But unfortunately, it's a big part of being smart in the world of crypto. And it's only just going to be even more important, particularly with these ATO changes as well. And obviously, maybe the US changes. Who knows what happens after Trump leaves office? You never know what can happen as well in the future. So you want to be aware, and you want to be, as you say, sort of budgeting and having an understanding of your holdings. I mean, I'm so funny because unlike you guys, I know Craig is very much a buy and hold sort of guy as well. I'm too much of I'm ruthless. Like if I hate it, I'll get out. I don't even care. I'll weave it. I'll bloody dump it into a shitty liquidity pool, whatever it is. I will just get because I'm like, the way I like to think about it is like, well, no, hold a minute. Like that money could go to zero. I might as well get out what I have left in that money, and that's mine. And now at least I have that decision to make another decision to hopefully make money in time. So it's funny because like I honestly don't even know if I would hold anything long term. It's pretty rare for me to hold something over months and months and months. Craig, any last questions for Matty? We've taken an hour of his time. Yeah. Couple more?
Yeah. I thought it might be a good chance just for Maddie to maybe tell the audience exactly what services they offer. If you're in Australia or the US, what you guys do. Is it consultancy? Is it software? Is it both? Give us a quick pitch about what you do and how you can sort of help people out there listening. Because I know there's we've just explained, tax is a complicated thing, and the more I look at it, and Greeny knows, you spoke about it earlier, I had to manually do last year's, and it was a friggin' nightmare, man. I wouldn't upon my worst enemy. Let us know what you do and how you can help people, Matty.
Yeah, definitely. So like the main thing that we've helped I added it up yesterday because I'm making changes to the website. We've helped over 1,410 investors now with like the data reconciliation services. And what that is, we get all of the crypto data into the tax software. We go through, we categorize all that, we make sure that the balance is balanced, and then we prepare the crypto tax reports that you can either take and you can self-file in the US with TurboTax, here with MyTax, or you can give it to your existing tax agent, chartered accountant, CPA, or as I mentioned, we're onboarding a chartered accountant who's a tax agent here in Australia who can help with the filing and advisory side for Australian clients. And we have both a CPA and a tax lawyer on the US side if some more advanced strategies are needed, but also just for filing. So we make sure that we've created this ecosystem where, like, if you're trading in crypto and you've got a tax problem, we've got a solution for you.
Awesome, dude. That was perfect. Yeah.
And I suppose I don't have any last questions. Craig, do you have anything more specific at all?
No, more just to say thank you for Maddie to coming on the show. I think this is the sort of stuff that's not discussed very often, and I think it's a topic that for some people they'll be like, "Ugh, don't even talk about it." You know what I mean? And I've sort of found in my life avoiding things like this ends up being worse than dealing with it at the time. So I would probably stress to the viewers out there who've been avoiding these sorts of topics, or at least researching for themselves to arm themselves with the information to actually file their tax properly. I think you can only avoid this so long until it catches up with you. So I think for any of the viewers out there, if you're not sure how to do this, reach out to Greedy, myself, but more so reach out to you guys. Reach out to Maddie, Crypto Tax Made Easy, and approach them and see what they can do for you. But I think this is a good conversation to have. I just want to say thanks for Maddie jumping on, giving our viewers the time. It's always great to talk about where we can get wins and, what the next opportunity in crypto is. But I think the other side of that is protecting your wealth by speaking to professionals like you. So I just want to say thanks for coming on and probably talking about a topic that's quite complex and hard to, give an answer to because everyone's situation is so unique, isn't it? So that's why I think you can't just get a cookie cutter approach and do it like that. So I think, thanks, Manny, for jumping on, and thanks for Greeny for getting you on today. It was a good idea, especially with all these laws coming in now, dude. Like, certainly I think it's time for all of us to arm ourselves, get the information. You made a good comment before. It's more about knowing what you're going to owe, or maybe ballpark, right, and having that money set aside, rather than getting like I do typically, where you get to sort of March and you start going, oh, I should have really put some money aside here. And you start to freak out and have to order a million transactions. It's very stressful. And like I said, I wouldn't wish it on my worst enemy. So long-winded way of saying thanks for jumping on and giving us some great info, dude.
No, I agree. And I'll second that. Thanks, Maddie, so much. I appreciate chatting to you whenever we can. And where can people go to find out a little bit more information about you?
Yeah, so if you want to follow us on X, it's at CryptoTaxSucks, because Crypto Tax Made Easy is too long for an X handle. But CryptoTaxMadeEasy.com is the website. And if you're interested in getting in touch, just go to the contact form and you can fill out a quote request, and we can get you a consultation as well.
Sounds great. No, Maddie, thanks so much. As Craig said, it's always great to have conversations with people in different realms of crypto. And this is certainly one of those realms, and it isn't a common conversation to have. So hopefully the crew and the people who are listening back to this replay get something out of this episode. So as always, guys, thanks for tuning in to MarketMates today. Another great show. Craig and I will be back the same time tomorrow, 7 p.m. Eastern Standard or 9 a.m. Australian Eastern Standard. If you are here in Australia, we'll be back again. And then we also have some more guests later in the week on Friday. Some fellow ape holders, Craig, will be joining us on Friday. So that'll be a good conversation about the future of NFTs perhaps as well on Friday. So I'm excited for that one as well. Craig, have a lovely day. Maddie, have a lovely day. Chat, have a lovely day or night wherever you are around the world. And we'll be back again tomorrow. See you later.
Thanks, guys.